Hey guys, Brian here. Hope your week's going great. In this video, we're going to look at this chart showing how pension fund managers are allocating money. This is, in essence, our money, and these guys get paid a lot of it to be on the correct side of the market. I think this chart's going to surprise you. Stay with me. All right, guys, welcome back. Some quick scenery today around Taroko Gorge. Really, really cool place. National Park, east side of Taiwan. We took a train to a city called Hulian. It took about 2 to 3 hours from Taipei. There's a million organized tours from Hulian. We just rented a car and drove around by ourselves. And if I was doing it again, I would actually just rent a decent sized scooter. That way you can kind of jump on and off anywhere and be on your way. Weather was supposed to be terrible, so we rented a car. But as you can see, everything just turned out great. Just driving around this place is really amazing, even if you don't do any hiking. So anyway, that's Taroko Gorge. Absolutely, absolutely loved it. I'll have some more footage around Taipei in a future video, but let's talk about these pension fund managers. We've published versions of this chart in the past. Very simple. Pension funds in the US, they hold a mix of assets like everyone else, some stocks, some bonds. This chart looks at cash. Data comes from Sentiment Trader. How much of these funds are allocated to cash? Now think about cash for a minute. Think about how we would want a financial expert to be allocated at various turning points in the market. At a peak in the stock market, we would want to just be sitting around in cash, right? Sleeping well at night. We would want these managers to be riding out the bear market, able to take advantage, have the cash on hand to take advantage at a low in the market. Well, back here in 1966, I'll talk about that date in a minute, but right at the start of a bear market, pension funds held relatively low percentages of cash, right? They were fully invested at a top in the market. Then at a low in the market in 1974, at the very moment they should have been fully committed to stocks, they're actually holding some of their highest cash positions in history. This is not good market timing. Now, there's a reason I'm highlighting 66 to 74. February 1966, that was the start of cycle wave 4 in the Dow. It lasted until December 74, and it shows the psychological effect of a big bear market. Look at this blue dashed line here. We drew it at 10%, but fund managers were so traumatized by this bear market that they kept their cash percentages above 10% for the first 20 years of one of the biggest bull markets ever. Again, these are the people we pay a lot of money to put us on the correct side of the market, and they are behaving as if they just opened their first Robinhood account. So I'll just leave you with this thought. What do current cash allocations say about the position of the market? We dropped to an all-time low in December 2021. We've come up a bit since then, but cash levels, they're still below levels that previously marked a big top, right? We're nowhere near cash levels that marked a bottom. Our view is that once again, a bear market has started. Once again, pension managers are on the wrong side of the market. They're positioned incorrectly. And once again, the bear market, at least so far, has done very little to change this kind of bullish psychology.